Philip Lowe's warning about the house price boom. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee. Let's look at this article from the ABC discussing Philip Lowe's warning on the house price boom. Let's see what this is about. The Reserve Bank has issued its bluntest warning yet about the dangers of the latest house price boom and the possibility regulators may need to step in to deflate it. Oh, fantastic. What do you think's going to happen? What do you think's going to happen if you announce pretty much infinite QE? We've got a cash rate virtually zero, and people are worried. Governments, states, everyone is stimulating the housing market. What do you think's going to happen? You know, there's this little effect, you know, the candle-on effect, where the money, you know, the entry point for money, the supply of money into an economy. Where's it all juiced up in Australia? Where does everyone put their money in Australia? Where are we all obsessed about property? Are we the most obsessed about property in the world? Do you think we beat the Irish? Oh, maybe the Kiwis might beat us. Maybe they will, you know. So, speaking at the Australian Financial Review's Business Summit, Mr. Lowe confirmed that the recent rise in house prices across most of the country to record levels in many areas had been a topic of discussion at the recent RBA board meetings. In a veiled warning to home buyers, Mr. Lowe cautioned that the prospect of lower population growth over the next couple of years could outweigh some of the other factors driving prices higher. Well, I mean, here's the thing. There's another article I want to look at from a media statement of the PM who was speaking at I think, the same event, where they're pretty much going to just start opening up temporary or increasing temporary visas for some of those skill shortages we have here in Australia. You know how our unemployment and underemployment is currently sitting over 20%, but we still have some skill shortages, so they're going to just, you know, bring more people in, only on temporary visas though. So that's kind of worse. Because then they'll earn their money and they'll bugger off home. You don't get them building a family and establishing a future here. So you get all the economic burdens without the long-term benefits. So, you know, brilliant, just brilliant. So there are many moving parts at present. Record low interest rates, a shift in preferences towards houses and away from apartments, strong demand for housing outside our largest cities, large government incentives for first-home buyers and home builders, and the slowest population growth in a century, he observed. Time will tell as to how these various factors ultimately balance out, but history suggests that shifts in population growth can have large effects on the housing market. The RBA will not raise rates to slow the housing boom. There you go. We've seen it before. They don't care about the house prices, guys. It's not part of their mandate. Their mandate is employment, pretty much, economic stability. Mr. Lowe reiterated that the RBA does not and would not explicitly target house prices with its interest rate policy. But house prices are probably the things they have the most effect on. It's sad. This is all, it's just sad, isn't it? Instead, he said it was up to the governments and financial regulators to address community concerns about soaring housing costs. I recognize that low interest rates are one of the factors contributing to higher housing prices, and that high and rising house price rise concerns many people, he said. There are various tools other than higher interest rates to address these concerns, leaving monetary policy to maintain its strong focus on the recovery in the economy, jobs, and wages. Some of those tools would include government policy changes, such as reducing the currently favorable tax treatment of housing relative to some other types of assets and income sources, while others also include some so-called macroprudential policies. So I wonder if he's alluding to, well, one thing, negative gearing as a strategy. This is the thing. You want the government. The problem is governments are going to use their monopoly on threat of force and on redistribution of wealth to always, you know, pick their preferred group. And it doesn't matter which side you have here in Australia. It's always going to happen. That's why I'd advocate for a kind of scaling back of the government, reducing the size and intervention of it, because it's always going to stuff it up one way or another. You'll always have nearly half the population completely unhappy or frustrated or annoyed. Whereas if the government pulls back and people actually are given the opportunity to work and achieve, then, you know, you'll feel happier. If you can build for something, not everyone has to be super high, super successful. You know, as long as you have the freedom to strive, that in itself can give someone a sense of fulfillment and a good life. But if you take that away from people... So, anyway, these are the types of lending limits that were imposed by bank regulators during Australia's most recent home buying upswing, which was centred in Sydney and Melbourne and peaked a few years ago. The thinly veiled warning to the home lending sector, Mr. Lowe said the Council of Financial Regulators, of which the RBA is a member, would intervene again if it felt that banks and other institutions were making risky loans. The Council of Financial Regulators has indicated that it would consider possible responses should lending standards deteriorate and financial risks increase, he said. We are not at this point, but we're watching carefully, and full employment. Mr. Lowe has also waded into the debate about full employment, saying he acknowledges there is some uncertainty about what constitutes full employment in Australia's modern economy. Full employment is widely considered by most economists to be the level of unemployment that leads to moderate wage growth and does not put excessive upward pressure on inflation. The RBA governor agreed that over the past decade, official estimates of where the level of full employment could be have been repeatedly revised downwards, both in Australia and overseas. But he is sticking with the idea that Australia can achieve and sustain an unemployment rate in the low 4%, meaning he thinks an unemployment rate somewhere between 4 and 4.5% would be full employment in Australia. We will be relying on the wages and price data to provide a signal as to how close we are, he said. The current situation is that we're still a long way from full employment. Well, the problem is you've got government intervention in the market setting a base to wages, and then you've also got a welfare program that disincentivizes people from working. That's it. The unemployment rate is currently at 6.4%. And as I was saying, the Roy Morgan unemployment and underemployment is over 21%. Because underemployment is if you're only getting 1 hour a week during the survey period, that's not work. Okay, that's a hobby. But that is enough to be considered employed. Professor Ross Garnett, one of Australia's most respected economists, has recently criticised the RBA's definition of full employment. In his new book, the professor said, an average of several 100,000 fewer people were employed in Australia between 13 and 19 than otherwise would have been possible. Well, yes, we've read about this before. He said the country's economic authorities, including the RBA, have been allowing the level of unemployment to exist in Australia because it helps to suppress inflation and wages. This is voluntary unemployment. Voluntary for the Reserve Bank because it is unemployment that the Reserve Bank chose to allow, he wrote. He said policymakers should stop guessing where full employment could be and instead return Australia to genuine full employment, an unemployment rate of 3.5% or lower, which would be the lowest it has been since the 70s. I mean, this is the problem. They're all intervening in the market. If you didn't have these interventions, if you didn't have these assumptions of full employment, well, that would change. We can find out where it is by increasing demand for labour until wages in the labour market are rising at a rate that threatens to take inflation above the Reserve Bank range for an extended period, he wrote. Certainly, it is lower than the well below 6% that Frydenberg said would trigger efforts to reduce the budget deficit. So business investment. Mr. Lowe said Australia's economy had recently enjoyed a strong rebound in consumption, with growth of 12% over the second half of last year, but business investment had failed to match it. He said machinery and equipment investment picked up encouragingly in the December quarter, but overall business investment was more than 10% below where he thought it would be at the start of last year. Non-residential construction is especially weak, with the forward-looking indicators suggesting this is likely to remain so for a while yet, he said. This weakness in business investment follows a run of years in which non-mining business investment as a share of nominal gross domestic product was already low by historic standards. Since 2010, this investment ratio averaged 9%, compared with 12% over the past 3 decades. He said there was no magical ingredient for boosting business investment, but it would help if demand picked up. A good starting point is businesses have confidence that the economy will grow and there will be demand for their products and services, he added. Well, here's the thing. I mean, who is going to invest in their business now in this economy? And there's so many disincentives to doing a business here in Australia. To employing people is painful. Just the hoops and the government bureaucracy you need to jump through to start a business here. And then why would you do it when you can just take your money, stick it in a house, sit on your ass, and make more money in property? Because it's just going to, it's they're inflating it. They'll chuck money at property. Your property, the government probably cares more about houses than your business. They're going to take care more of your bloody houses that you've invested than the business you've worked at. So why would anyone do it? Why? And then what you do is you start a course, you put it on YouTube and on Facebook, Instagram, and you charge people to buy one house after another. That's it. Look at me, a multi-millionaire with 50 houses. Made all the money doing the courses about buying the houses. So the bond buying program, infinite QE. Remember when we were talking about QE last year and how people thought it'll never come to Australia? Remember that? Mr. Lowe also said the RBA board would consider later in the year if there was a case for another extension of the bond purchase program. We are prepared to undertake further bond purchases if that is required to reach our goals, Mr. Lowe said. Until then, we remain prepared to alter the timing of purchases under the current programs to respond to market conditions. We did this last week when liquidity conditions deteriorated and the bid-ASL spread widened noticeably, and will do so again if necessary. The Reserve Bank is currently targeting a 3-year Commonwealth government bond rate of 0.1% and also seeking to put downward pressure on longer-term bond interest rates. Currently, the bank is targeting the 0.1% rate on the bond that matures in April 2024, but it is considering whether to move on to the next bond, which matures in November 2024, effectively extending the period of ultra-low rates. The board has not yet made a decision on this question and will consider it again later in the year when it has more information about the economic recovery and the labour market, Mr. Lowe said. So there we have it, everyone. There we have it. A warning about jumping in to the property market. Looking at more interventions to kind of address the boom. And here are the key points. RBA Governor Philip Lowe admitted low interest rates are driving up house prices, but said the bank will not adjust its policy based on the housing market. Mr. Lowe said there are various other tools to keep housing prices in check. We'll see. The RBA and other financial regulators are watching carefully to see if home lending restrictions are necessary. So wouldn't you love it? Wouldn't you love it if you just borrowed all this money, bought a house, and then other tools are implemented and the market corrected? What do you reckon? Anyway, guys, thanks for watching. Please like, share, and subscribe to the channel. Let me know your thoughts and opinions in the comments down below. If you enjoy the content I cobbled together here, there are a few ways you can support us. You can join us on YouTube or Patreon. You can support us using our affiliate links from Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day. I'll see you in the next episode. Bye for now.